Okay, so welcome everybody. We have a really exciting topic today. Has accounting gone bad? I'm going to turn it over to Jake Thomas, and he's asked for 5 minutes uninterrupted approximately, and then we'll have an open forum for discussion. You can write questions in the chat, or you can, sort of wave your hand, and I'll make note to Jake where he needs to know that someone's asking a question. Take it away.
Thank you, Stephanie. Thank you, Ayung, and Stephen, wherever he is on his way from Maine to New York, for organizing this. I'm really looking forward to your comments and suggestions. I'm going to start out by introducing my co-authors. Dan is a PhD student at Yale, so all the blue people are Yale blue. And Frank Zhang, and Panos has California Gold and Berkeley Blue there. This has been a project that the four of us have been working on for a long time. And I will show you why in a minute. Okay, so let me just get this started here. So just briefly, there's going to be 3 parts to the talk. There's going to be anxiety in the beginning, and I'll try to explain to you why the anxiety, it's a very key relation is flipped. And then we're going to discuss the possibility of a fix. And then we're going to find even after we put in some kind of a fix, there's still going to be a declining trend in some measure of quality. And the question is it going to be accounting or is it the operations and the economics of the firm that are driving that? Okay, so without further ado, here's the cause for concern. And basically, the variance of earnings is about 8 times the variance of cash flow. So it's the black line is the cross-sectional variance of earnings. And the red line at the bottom is the cross-sectional variance of cash flow from operations.
Jake, sorry to interrupt. I think people can't see the figure, so you may want to sort of.
The figure doesn't show?
No, you're still on the title page.
I mean, does the PowerPoint show it all?
We just see the title page.
Only the title page is not moving beyond the title page.
Oh dear. It's moving for me. Okay, let me try. I'm going to close it. Screen sharing is stopped. Let me try and share again. Share screen. Guess I need to reopen PowerPoint. Okay. Oh dear. Let me start again. Share screen. PowerPoint. Share. What about now? You see the opening screen? Yeah, things are picking up.
That's good.
Working.
Excellent. So we got. Thank you for catching that on us here. What's going on and on. So we expect the variance of earnings to be less than the variance of cash flows. And in fact, it's the exact opposite. And not by a little bit, but by a lot. So that's the quote unquote problem. Just to give you a little bit of context, this is annual data. As I said, it's cross-sectional using levels of cash flows and accruals, and everything is deflated by assets. So now you can sort of think about what the variance is. If earnings is cash flows plus accruals, then the variance of earnings is the variance of cash flows plus the variance of accruals plus 2 times the covariance. And what you'll see here is that the green dashed line is the covariance. And the covariance, you would expect it to be negative. In fact, sufficiently negative where it would overcome the variance of accruals. And then that would cause the variance of earnings to be less than the variance of cash flows. But here the problem is the covariance itself is positive. And so just to confirm that, the blue line is the slope of the accruals cash flow regression. The red line is the R squared. And we're expecting to see a negative slope, but in fact it's positive and it's increasing. So we have these two diagnostics, the variance of earnings relative to cash flows or the slope, and they're both going to basically tell us the same thing. It's going to be convenient to use the slope, which we're going to call the smoothing coefficient. The more negative it is, the more smoothing there is, as an indicator of the relative variance of earnings and cash flows. Right? So you'll see us mostly talking about the slope, but occasionally we'll switch back to the variances. So you might ask, well, so what? And the answer is earnings predictability is going down because the variance is going up. The persistence is going down. The relationship with price, if you want to call that value relevance, is going down. And by the way, it's just as bad if you switch the deflator from total assets to sales. And it's not as bad, but still bad if you deflate by market value. Right? So it was kind of unexpected for us. And so if we just for terminology, if you define smoothing as the lower variance of earnings relative to cash flows, and that reduction in variance can come, should come from accrual accounting, but it could come from managerial smoothing also. And we're going to assume that smoothing is desirable. And we'll just call it accounting quality for convenience, right? So think of it as a label to move forward, but we're interested in why the variance of earnings is not, considerably lower than that of cash flows. And this is a question that's been asked before. And Bushman, Lerner, and Frank Zhang have a paper, and they came up with sort of two reasons for why that might be the case, that the slope has gone down over time. It is not as negative. Some of them sound like accounting has changed, more one-time items and things like that. Some of them have to do with economics has changed. And our point is going to be that it may be something else. And so here's what our story is for something else. It has to do with a substantial group of firms have negative CFO. So think of them like a biotech startup. They also have low total assets and low sales. So they're like phase 2, some drugs. They're just spending money on R&D and other expenses. There's not much in terms of assets because R&D is being capitalized, is not capitalized as expense, and there's not much in sales. They also have negative accruals because about 60% of them have current liabilities more than current assets. And so as the firm grows, you can see that the liability side is going to cause negative accruals. And both the negative CFO and the negative accrual are inflated when they're scaled by very low total assets. This induces a positive accrual cash flow relationship, which overwhelms the strong negative accrual cash flow relationship from the CFO plus firm. And this is what is going to make the variance of earnings to be much higher than the variance of cash flows. We didn't see all this in one flash of insight. It took us a long time and many connecting steps. So I think it's useful to kind of walk you through how we see all this before we move on to the other parts of the paper. So the first step is that there's other evidence that suggests that smoothing is widespread. And for this, I have to thank Sudipta. I met him at a conference, and he basically said something like, "Isn't Frank Zhang your neighbor?" And I said, yes. And he said, how can Frank write a paper that says X and you have a paper that says not X? And I said, that's a good point. And so this is sort of in the other paper, which has the opposite result. This is a paper with Feng Sun. Some of you may have seen it. The correlations are very negative between delta cash flow per share, delta accruals per share, whether you take, Pearson or Spearman, they're like, for example, the Spearman correlation starts at minus 0.63 for the first price decile and just keeps getting more and more negative for the 10th decile. So these correlations are strongly, strongly negative. And that was evidence for us in that paper that smoothing is prevalent, and the smoothing sort of increases with share price. So there's also similar correlation. These are cross-sectional. If you did them, firm by firm time series, you get the same sort of result. And we actually had a plot of the variance of earnings news and accruals news. And the top line is the variance of cash flows. The next line below that is the variance of earnings. And again, as the price deciles go up, this is a famous result in DeGeorge, Patel and Zeckhauser, that the variance of earnings measured in cents per share doesn't change with share price, whereas cash flow does. And the main thing to remember here is that the specifications are different. In this paper, we're using quarterly data rather than annual. The deflator is number of shares used to calculate EPS, so it's per share data rather than asset deflation, news versus levels. And the question is, which one of these research dials has caused the difference in result? So we're going to do the first research dial, which is to change the deflator to number of shares, and immediately everything changes. The variance of earnings is the black line here, cross-sectional year by year. The variance of cash flows is the red line. And you can see the variance of earnings is about half that of cash flows. Just a complete reversal by switching the deflator. And if you notice, the green line at the bottom is the covariance term. It's become solidly negative, and that's what's causing the variance of earnings to be lower, that covariance being sufficiently negative. And so this is just to confirm that it's not only the variance that, because the covariance has become negative, the signs of the smoothing coefficient have also are negative. They're no longer positive as they were before. So the question is, why does changing the deflator make such a difference? And it's a little bit hard for you to see, but the left side of this plot is a plot of earnings divided by total assets. And on the right side is a plot of earnings per share. The red line is the median in both. The green line on top is the third quartile. The black line below is the first quartile. And the dashed line is the mean. And just by looking at the mean, you can tell, and the first quartile, that the asset deflated numbers, when they're negative earnings, they just get skewed tremendously to the left because of the low total asset problem. And it's not just a handful of firms, it's at least 25% of the firms. Maybe more. In our case, the CFO minus is going to be about 30% of the sample. So it's a substantial sample, portion of the sample, and any asset deflated number is getting skewed to the left, becoming more and more negative. In the case of earnings per share, it's relatively steady over time during our sample period. There is going to be a little bit of the third quartile moving up as you have the equivalents of the Amazons and Googles not splitting as often as the Apples and Teslas are. But that's basically the reason why one deflator is so different than the other. And so we're sort of like, okay, I understand asset deflation is increasing the magnitude of deflated losses for small firms, but why does the sign flip? Given that both total assets and number of shares is always positive, it's a little bit hard to see why the sign of the coefficient would flip just because you had more negative values being sort of stretched out.
Jake, I think Sudipta has a question.
So Jake, on that graph that you have up here, is total assets end of period or beginning of period? Because the end of period would be affected by negative earnings, right? So if you have negative earnings, it's going to make your assets go down at the same time. Whereas if it's beginning of period, it's different. So I just want to know which one is it?
I'm not sure. I think it's beginning of period. Dan is here. Dan, if you unmute yourself, yeah, do you have the answer to that question?
So here we use average assets. We use the beginning and ending period, and we average it.
That's right. I mean, we can redo this at the beginning, and we should, just to make sure that's not the cause. So this is where this paper by Dennis and McKeown, it's a working paper, comes in. And if you haven't read it, you should, because they tell the story of these startups and how they're so different. They're constantly issuing equity in private placements, building up a cash balance, running it down, negative cash flows, you know, a whole bunch of relationships that are so different from your traditional firms, and yet they're a very sizable portion of our samples. And so this is sort of we're going to take the sample, break it up into ventiles, 5% each, and we're reporting the mean values of accruals divided by total assets on the y-axis and cash flows divided by total on the x-axis. And you can see how there's only a few of the ventiles on the negative cash flow side. You know, most, I think about 70% of them are 14 out of the 20, I think, are on this side. But you can see that there's a positive slope for negative cash flows. There's a negative slope for positive cash flows. But if I were to draw a regression, you can tell that the regression of the combined sample will be positively sloped because of the negative cash flow sample being stretched out to the left. You know, it's just that's how a regression would work, right? So visually, the regression line is going to be positively sloped because the CFO minus mass is sort of more dispersed. We have a little bit of algebra where you can tell what the overall slope is. It's a function not only of the variances of the two subsamples or the two partitions, but also the means and things like that. So this is what's happening why the overall sample has a positive slope because of the negative partition, CFO partition, just swamping everything else. Well, when you switch to per share deflation, the negative sample gets sort of pulled down, gets squeezed in, and the slope also switches from negative to 0. So that's going to be the big difference. Now the overall regression is going to be, you know, positive because the right side, you know, the right partition carries its weight, and that's sort of the answer to this question.
So Jake, I didn't want to interrupt you. I knew you were reaching crescendo, but Ayun has a question.
Hi, Jake. I have a question, very, very high level. I probably should have asked it on your first slide. So when we talk about earning smoothing, I always think about it's in the time series that managers or accounting rules try to smooth their accruals across different time period for a given firm. But I think the whole literature, including this study today, is more about like cross-sectional variance. So the variance we talk about here is for a given year across firm, what's the earnings a firm compared to the rest, and then that variance has increased 8 times greater than the cash flow cross-sectional variance. Is that correct? I just want to confirm that that's what we are actually looking at on the graphs today.
Yeah, you could think of the cross-sectional thing as a measure of heterogeneity. You know, how much difference is there in the cross-section? But as long as for each firm, the time series variance of earnings is less than the time series variance of cash flows. I think you'll see in the cross section that result flow through. I think that's the implicit. We're going to do time series in a minute, so we're not going to walk away from that. But
Okay.
you're absolutely right. You might think, how are the two related? How is the cross-sectional variance related to the time series? And I don't think anybody's talked about that explicitly. I think implicitly the assumption is there is some heterogeneity across firms in sort of their business model.
Yeah.
And then all firms, if they're trying to smooth over time, one should see not only time series variance of earnings being low, firm by firm, but also the cross-section being low.
Okay. Yeah, thank you. That helps. It's just like it's hard for me from the conceptual level to the empirical analysis. One is a time series argument. The other one is a cross-sectional empirical regression. Yeah. Thank you.
Absolutely. Yeah, 100% Okay. So now we're sort of saying, wait a minute. We've got a total of 4 deflators. And we're going to go into deflator land, for a little while and see if we can come up with some diagnostics. But before that, there's going to be an even more fundamental question, which is why deflate? And you open up the literature and there's a paper all the way back by Shamsunder and Baruch Lev saying there is no reason to deflate. If you are worried about heteroscedasticity, there's ways to deal with that. But somehow we all feel more comfortable deflating. And of course, there's also a paper by Mary Barth and Sanjay Kalapur, which spent some time on this issue. They too worry about why do you want to deflate? You can create biases if you deflate. Fundamentally, their argument is if the relationship between Y and the deflator and X and the deflator, if it doesn't pass through the origin and you deflate, you're going to create all kinds of relationships that don't exist. So, what we're going to do now is try everything because we're in a little bit of a conundrum. We've got 4 deflators: assets, sales, market value, and shares. And 3 of them are saying one thing, which is the slope is negative, the variance of earnings is higher. And 1 is saying the opposite. And the question is, which one is more reliable? So what we're going to do is, we just did the cross-sectional regressions, with deflation. I'm not going to show you the results, but we're going to switch to, and this is something that both of the papers I mentioned suggest, which is run a undeflated regression, throw the deflator on the right-hand side as a regressor, and see whether you get different results between deflated and undeflated with the regressor. If you get the same results, then you feel a little bit more confident that the deflated regression isn't biased. And I can, let me show you some results here. If you switch to undeflated OLS with the deflator included as a regressor, you're basically getting, with all 4 deflators, you're getting negative slopes. So, just switching from deflated to undeflated has this impact. All the 4 now align with the per share number, which we had before, and they're the opposite of what they showed in the deflated regressions. So let's see here. All slopes are negative, and we're going to do the next sort of diagnostic is, what if you use weighted least squares? So again, in the accounting, what we do is we sometimes might put in a filter and say, small firms are weird, let's get rid of them. And you could sort of maybe try to get the same effect without throwing out the firms by weighting the big firms more. And that's, we tried that. And sure enough, the deflated regressors, with the weighted least squares, giving more weight to the large firms doesn't have the problem I talked to you about earlier. And so again, everything is negative in this specification. The next one, which we try, my cursor's not behaving itself, is to see whether deflation induces a relation with the deflator. Right? So imagine you're looking at the deflated values of cash flows divided by total assets. You throw them into 10 deciles. The average value of total assets for the 10 deciles should be the same, right? But if deflation is doing something strange, then you'll see a relationship between the deflated variable and the deflator. And so we're going to use that as a diagnostic to tell whether the deflator is doing, whether it's interfering or not unexpectedly.
Ayan
With
has
that in
another
mind-
question. Jacob, sorry to interrupt. Ayan?
Do you want to finish this? Okay, so I think I'm glad that you did the weighted least square, because that would put more weight on larger firms, right? So like so far those evidence, including those per share graphs, do you think that mainly just the firm size, small firms, negative cash, operating cash flow, negative earnings firms driving this bizarre graph that you show in the beginning? If we don't have those smaller firms, then everything was still smoothing. So the covariance still negative. So mainly the positive is just because we have more younger age ventures in the economy over the past 20, 30 years. And then when you run the cross-sectional variance and take the average coefficient, you just put more weight on those smaller firms. Is that the reason behind all this deflator and also the differential graphs across deflators? It's just the firm size. It's just the population has more smaller firms.
Yeah, there's small firms, but they're also, they have these other properties, which is that the accruals are negative.
Yeah.
And
Cash flow is also negative.
Yeah, cash flow is negative, and that the positive relationship is induced. Yeah, there's a bunch of things happening, but the fact that they're small and that they become smaller with total assets and sales, relative to their other size, they're relatively big firms. It's just that they don't have lots of assets and sales.
Yeah, so using their smaller sized total assets as deflator somehow make them very influential in the regression of variance. Okay, yeah,
Exactly.
thank you.
There's a book about.
Thanks. There's also a question from James.
Hi, Jake. I was wondering if you'd considered adjusting total assets rather than throwing it out. So what you're seeing is a lot of these small new firms that don't have much in assets. And then there's a lot of larger firms that are asset heavy because they've built up their goodwill over the past 20 years or so. And so effectively, goodwill and these other intangible assets get treated differently for those who internally develop them as opposed to buy them. So I was wondering if you focused on tangible assets, you'd be able to kind of maintain our pretty traditional deflator, but correct some of the issues that you're seeing.
By the way, James and I have a paper on intangibles. he's putting a plug for that paper here. But James, can you, what exactly do you mean by tangible assets?
So if you were to remove goodwill as part of total assets, effectively it would give greater weight to these more traditional firms. And so I'm wondering if it would correct kind of the right side of those graphs that you were showing earlier by allowing greater weight because they have smaller denominators on the right side of those earlier graphs.
Yeah, well, certainly it's on our, we should put it on our to-do list. I think giving more weight to the larger firms by reducing their total asset base will increase their influence for sure, but I think the fact that the small firms have this positive slope it's still going to be a problem. By the time we're done, we'll see that the small firms are actually not that different than the large firms. If you change the specification. But yeah, so thanks for the suggestion. We will definitely try to see that. We did something that was sort of in the same spirit, but different, and that was we tried to use the book value of equity. And we realized the book value of equity has this problem but if you only look at paid-in capital portion of the book value of equity, then a lot of the small denominator problem is reduced. And I forget exactly what we found, but actually the paid-in capital portion of book value of equity behaves better, quote unquote, than total assets and sales in this particular regression.
It doesn't fix everything, but it does behave better than total assets, right? And it has to do with the accumulation of negative operating earnings over a very long period of time, and negative retained earnings kind of pushing the book value of equity to negative territory for many of those firms. Jake, one more very quick remark regarding the age of those firms. And I think that's why the Dennis and McKen paper is very relevant. So many of the firms in our data that have negative operating cash flow and are technology intensive, so a lot of the assets are off the balance sheet, are actually not startups or super young firms. They can actually sustain operating losses for a very long period of time. So they have the ability to raise financing and finance their investments in intangibles. And these are not necessarily IPO firms. They can be in this situation for a long period of time.
Yeah, again, it's really worth reading the Dennis and McEwen paper because it's a sort of a part of our sample that is so different in many ways. Just the idea that they issue equity as often as they do, is itself so unusual. Yeah, well, let's see how we're doing for time. We got plenty of time. So we're now going to look at whether there's an induced relationship when you deflate. And here's sort of 4 sets of columns. The first 2 are deflation by sales. The next one is market value. The next one is total assets. And the last one is shares. And the first in each group is the deflated variable. And the second one is the deflator. And we're only focusing on the CFO minus partition. Remember, that's the one that had the very long tail that was driving everything. And as you go from decile 1 to decile 10, you're going from more negative towards 0. Right? So that's the way it's set up. And you can see that the most negative CFO over sales has very low sales. This is the average level of sales. It's 2 million. And there's just a clear relationship where as you go from the left tail towards the origin of that previous graph, the average level of sales is rising. It's for market value, it's not as much, but this is the total asset picture, which is firms at the kind of lower left tail of that graph were firms with very low total assets. And what we're saying is deflation is inducing a relationship between the deflated variable, and the deflator. And so this is you can maybe think of it as a diagnostic, as a very simple diagnostic to tell you whether or not your deflator is causing bias. When you go to number of shares, it's actually not bad, except when you get to the 10th group, where you see sort of a big jump in the average number of shares. These are in millions. So that sort of, helped us to think more about deflators. Again, we're not, we don't have a strong position on whether you should deflate or not, or anything like that. But if you are going to deflate, it does seem like, we should sort of look more carefully. Okay, so that was one more. So, where's my cursor? thing that we learned from going into the deflation question. We also did time series regressions by firm. And we're going to find that as long as you do time series regressions by firm with total assets, you're going to get negative slopes. And actually, BLZ had already documented this. So this is firm by firm, and we've got the percentiles of the slopes, and you can see that that at least almost up to the 75th percentile for asset deflated firms have negative slopes. And the per share basis, it's slightly a little bit more than 75, but a substantial amount of the firm by firm slopes are negative. So this sort of Ayung's question, but in this particular case, the kind of going from cross-sectional to time series actually flips the sign, and similarly for the variances and so on. So, kind of the standard intuition for why something should carry over doesn't seem to apply as much here. So most firms have negative slopes for both deflators. I don't think we've done this for sales and for market value. We could. Tell you the truth, we're not quite sure how to think about market value when we're running regressions of accounting variables, to the extent that even lagged market value has information about future accounting variables. And so could the deflator, in some sense predict levels of accounting variables, and what impact that would have is something that it's sort of always sitting in the back of our heads. Clearly, if you've got returns or something in the regression, then market value as a deflator makes more sense. But if you only have accounting numbers here, I think it's a question sort of worth thinking about. So that's our time series regression by firm. And I think our main point is, for every specification, other than the deflated cross-sectional, for which we got 3 votes negative and 1 positive. I'm sorry, the other way around. 3 positive and 1 negative. For every other specification, for every deflator, it seems as if the slope is reliably negative. And which is the per share result at the cross-sectional level. And so we're sort of concluding that, yes, the per share result is reliable, the total assets deflated and sales and so on are distorted by the small denominator problem and some other issues. So that's our kind of closing of that part of what's the problem and what's the fix. And at this point, the last few times I've presented the paper, there's been a lot of pushback saying, are you telling me that I should deflate by number of shares? And I think the answer is yes, we are saying that, at least for this particular set of regressions. But it bothers people a lot to deflate by number of shares. Conceptually, the idea is that the number of shares is a kind of an arbitrary number. It's a number that you can pick any number you want, and that's going to affect what the per share number looks like. And I think it's a good discussion to have. And we offer some arguments for why deflating by number of shares makes sense. And it sort of sounds something like, it may be an arbitrary number, but it's a number the manager chose. And if it's a number the manager chose, they had something in mind. And clearly they had many things in mind. But one possibility is that they wanted the scale of a share to be the same over time or similar across peers, so that when they have conversations with each other, within the finance business, with analysts, with investors, and so on, using per share data is meaningful. And so, maybe that's a reason why per share data is comparable across time, these firms.
We have a couple of questions. The first one from Mayung and then from Sudipta.
So Jake and panels, I kind of feel like your recommendation for using per share for this particular regression, cross-sectional regression during this sample period, it's kind of like it's exposed discovery, right? I don't know whether going forward up till 2030 and 40, do we still find per share is the better deflator compared to other deflators? So that's kind of like the pushback I have in mind when I read the abstract, is that this is an in-sample horse race, and then you find per share is a better deflator. We think it's simple for this specified regression, but once we switch to another regression model, cross-sectional or time series, and for a different time period, you may find beginning total asset is better, or reduce or induce less biases. So I just want to hear your thoughts on this recommendation is something that ex ante before you take a look at the data, or is actually exposed after you have looked at the data. This is something good to use if we are going to analyze cross-sectional regression during this time period. We should use pre-share. It's a different kind of recommendation or influence for other researchers, right?
It's completely exposed. We actually have a little history of accounting research, how it started out more on a per share time series basis, and then it switches to cross-sectional, and then switches to asset deflation. Asset deflation makes more sense for accruals because accruals show up on the balance sheet. But it is completely exposed, our per share recognition, and it is specific to this sample period and this regression of accruals and cash flows cross-sectionally, right? I mean, so it's a very narrow finding. We're not saying that it is always going to be the best. In some sense, we're saying, look at different deflators, try some of these diagnostics, feel comfortable, ask yourself if you need to deflate at all. All those questions are coming up. But in that, specific answer to your question, it's exposed, and it's only for this setting.
But Jake, to be fair, in terms of the diagnostics, right? Because we understand that those relationships can change depending on the time period, the cross-sectional heterogeneity, US versus international data, the filters you've already imposed to derive your sample, right? And I think that's why the diagnostics are so important, right? In terms of evaluating the sanity of different choices of deflators. So I would actually argue that, we don't necessarily have to make a recommendation as to what the deflator should be, but whatever it is that you use, here's a set of diagnostics that you can use to evaluate the sanity of these choices. So we have a question from Sudipta, and then we have another classic comment from Peter regarding Berkshire Hathaway. So I guess you can start with Sudipta.
So I have two questions. The first one is on this number of shares. Number of shares?
Yeah. Yeah.
So in the US, it's very different from other countries because US firms tend to pick a share price between $20 and $30. So there's a paper in JEP by Weld, Micheli et al. That shows that from the 1920s to the 2000s, US share prices have tended to stay in this range of $20 to $30. But this is not true for any other country. Okay, so that's something that's unique to the US. And so it is what managers are choosing. There's a norm here, but it's very distinct from anything else. So the second question I had when you talked about market value predicting future accruals and cash flows, it seems to me that assets should also be doing that. That's the definition of an asset. And so should, in some sense, sales. So I'm not clear why market value should be conceptually thought about differently than assets and sales.
So on the second question, I'm not going to try and add. Let me think and give you a more reasoned answer. But on the first question, we did actually plot from way back, and 2000 is when within the trading range story starts to break down, and actually the distribution starts to shift up. Again, because of a lot of firms not splitting and having these $1,000 shares and so on. Yeah, so there's, I think your point about it being specific to the U.S. and specific to the pre-2000s, is a good point. And we're aware of that. Panos, you said there's a comment about Berkshire Hathaway?
Yes, so Peter has a comment on the chat. Should we worry about the influence of, for example, Berkshire Hathaway in a per share regression?
Yeah, we should. I don't know. In fairness, we do have a 1% trimming on each end of the distribution. I don't know whether that's reasonable or not. And I don't know if Berkshire Hathaway gets picked up, whether it sits in the 1% tails of the deflated regressors and accruals. But
even with that, Jake, the regression will be influenced unduly by the firms that have a low relative number of shares outstanding. It's inevitable. You're going to have a cluster around 0 in the scatter plot, and you're going to have a few observations off the chart in the top right-hand corner.
Yeah, since we didn't look at the scatter plot for the undeflated regressions, but I think conceptually, if the samples are all drawn from the same population and they just have different scale, there's no reason why a particular observation unduly affecting the regression causes bias, right, ex ante.
Nor is there any reason to assume it wouldn't cause bias, Jake.
Right, yeah. But if you think that there are different populations, that large firms are different than small firms and so on, then I suppose the argument would be to separate them, talk about the different populations or subpopulations. But this is clearly a topic that's way above my pay grade. So I'm going to say I don't know exactly how much Berkshire Hathaway or Amazon or any one of these firms now affects the regressions if we were to go undeflated with the deflator on the right hand side.
So Jake, after trimming though, we do have the scatter plot that you just presented on slide 14, where you have the plot of the per share accruals plotted on the cash flows on per share basis, right? So that's effectively the portfolio, the Ventile portfolio analysis of the data. But we're going to take another look at the influential observations. Zach has another comment.
Yeah, thanks, Panos and Jake. Great to see everybody, by the way. It's a great opportunity. So one of the secular trends that is going on since I'd say, mid-2000s is the increasing number of shares, number of buybacks. And that has a great influence on the number of shares. Now, I didn't do all the back of the envelope calculations of how that might affect the regression coefficients here, but it's something to consider, especially because buybacks are not random. And so just something for you to think about. If you just plot the buybacks, you'll see it. And I think it has something to do here.
Right. So some of the firms that do a lot of buybacks are also doing a lot of employee equity, option issues or equity issues. So some of it is to maintain the number of shares at some desired level. But some other buybacks, as you say, are not, offset by issues.
Yeah, they're not. I mean, on net, they're not. Yeah.
Exactly. But yeah, we should take a look at that. So, just a couple more things, but I want to spend the next 10 minutes on our main finding, which is yet to come. So the CFO minus subsample starts behaving more normal with a nice negative slope when we switch from levels to news. And we have a simple model, kind of a nonlinear model, to estimate news and accruals and news and cash flows just using lag values with a different slope depending on the sign of the lag value. But we now want to kind of close with why is smoothing declining over time, right? And so after we do all the per share and things like that, there's no doubt that even though the slopes are substantially negative, they're becoming less negative over time. And this is something that's been documented everywhere. And so what we're going to do is we're going to follow a slightly different approach, which we can, if you focus on the slopes, is we're going to decompose accruals into components. I think we've got 4 components. And we're going to find that it's not what we call conditional conservatism, which is write-offs and things like that. It's not depreciation and amortization. It is in fact working capital. So we sort of, working capital is going to look like the overall slope and the others are going to look flat. I'll just show you the picture in a minute. The next thing we're going to do is we say, okay, if it is working capital, then we're going to decompose it and find that it is actually mostly inventory and accounts receivable. That is, showing a parallel trend to the overall slope, whereas the other components of working capital are somewhat flat. And then finally, we find that the decline in those 2 slopes seems to be related to the level of inventory and accounts receivable. So we're basically going to conclude that if it is inventory and accounts receivable, it's the levels, then it's not accounting. It's highly unlikely that accounting rule changes are going to explain what's going on with the overall accrual cash flow slope. It's just kind of firms have less inventory and many firms don't have inventory at all. That's what's causing, and inventory is going to actually be even more important than accounts receivable, because when you've got these 2 trends, they're actually the unit roots and we've got to do all kinds of things to fix that. But once you look at it, it does seem like inventory is the main driver and accounts receivable to a lesser extent. So let me just show you those pictures and then conclude. No, that's not what I want. Why is it declining? Huh. So this is the breaking it down into short-term accruals, which is working capital, conditional conservative, which is special items, depreciation, amortization, and everything else. And the top 3 lines are for the other 3, and the bottom line is for working capital. So remember, the picture we're trying to replicate is something going from large negative to sort of medium negative over time. And you can see that this one seems to be driving the overall slope, right? So the sum of these slopes is the overall slope. And what we're doing is just catching the one that's the biggest mover here. Now we're going to take working capital and break it up into 5 components: inventory, accounts receivable, accounts payable, taxes payable, and all other. And taxes payable and all other flat lines, they're also very small in magnitude, so they don't have much of an effect on the slope. It's the black line here, the dashed black line, is accounts payable. And you'll see that it's going to go up a little bit towards the end. And we'll find out that it going up towards the end is going to be caused by cash flow variance, sort of increasing, at this point. So it's basically the blue line and the red line, where the blue line is accounts receivable and the red line is inventory. Right, so it's news in these two components of working capital accruals that seems to be driving the overall trend.
Quick question coming from Sudipta. When we try to identify the conditionally conservative portion of accruals, do we have to assume that every notion of conditional conservatives has to flow through special items?
No, I mean, that's just, we're calling it conditional conservatism, but it really should be called special items. And we're assuming that special items are all accruals. So anyway, so this is our, story for the two items that seem to be driving the overall slope. And this is the levels. For the blue line is the level for accounts receivable, so the median level of accounts receivable per share over time. The red line is inventory, and the black line is accounts payable. So once again, we have to do some sort of, vector error correction model and so on to see the connection between these slopes, these trends, and the overall trend. We haven't yet, reported those results, but it's mainly going to be inventory, the level of inventory that's explaining what's happening for the overall slope. So, seeing as I'm coming towards the end, I think what I should do is conclude. Let me see if I got something here. All right, yeah, maybe let me just say one more thing, and that is sort of, here are regressions, or simple regressions of accruals on cash flows, but the Dichow-Dichev regressions also have lagged and leading cash flows. And so all we're saying is, does the switch in deflator going from asset deflation to share deflation, does it affect other studies that are similar? And the answer is, again, yes. When you look at share deflation, the asset deflated slope sort of gets to zero, here, whereas the per share is solidly negative. So with that, smoothing is alive and well. The positive slope and the higher variance for earnings are unrepresentative. They're due to asset deflation, and they're due to the partition with negative CFO. Negative slope and lower variance of earnings is observed for all other specifications. The negative slope is robust, including for the CFO minus group, as long as we use per share data and news. There's a question of which deflator to use. We talked about that. At least in this context, if you want to apply, run cross-sectional regressions, it does seem like per share is better than the others. The decline in smoothing is unlikely to be due to changes in accounting rules because it's mainly coming from inventory and accounts receivable, two items which haven't really experienced big changes in the rules, the accounting rules, but they have seen changes in the levels. So what I need to do is to say to myself, especially in these COVID days, be happy, don't worry. And I wanted to also tell you about next week. We have Gil from UT Dallas. He's going to talk about whether earnings have lost their relevance. And with that, I will bid adieu, unless we have some more last minute questions. Okay, well, thank you all. Really appreciate it.
Thank you, Jake. You did a great job.
Thanks, Stephanie.
Thank you, Stephanie. Thank you, Jake and panel.
Bye.
Thank you. Bye.
Jake, can I ask you a quick question?